This is one of the kind of moments that active managers look forward to, because you can reposition portfolios, you can assume risk at better prices, but this is far from over. The Russian or the incursion into Ukraine is the beginning of a game that is being played between major powers around security, and we don't expect this to be over within a week or two. And of course, the impact on commodity markets, the impact on supply chains, very important. But it's not the most important moment in markets. I mean, I would say the inflation story that's unfolding, the interest rate story, will, if we look a decade from now, if we look back, will dominate much more, and will have much more influence on what has happened to investor outcomes. And I also think the Chinese technology story that emerged this morning is equally important. But clearly, politics dominate the headlines for now, and markets.
Yeah, for now. And you are, JP Morgan Chase, Hendrik, would agree with you, saying this morning in a new note that basically a Fed policy error and inflation and monetary policy tightening are a bigger story for the equity markets than indeed this Russia news, however global it is. Do you think that either the global equity markets at least are overreacting a bit, hitting sell now, we'll think about this later, or is this really just kind of another punch in the gut on what has already been, to your point, macro worries about inflation?
I think when markets move like this, it's always because risk has been building up in the system. There is substantial risk, and I think the de-risking move is telling us that people were nervous ahead of time, but we shouldn't ignore the opportunities. I mean, if you look at the strength in commodity currencies, if you look at the benefit that is going to flow through to other, not Russia, other commodity producers, if you look at the buying opportunities or investment opportunities that will emerge in the mispricings that will follow, I think one must stay very calm and not go into overall panic. The risk is always that the headlines drive investors, particularly retail investors, into panic, which they then regret. I just remind everyone what happened when the COVID outbreak happened in early 2020, and what markets did subsequently.
That is an excellent point now, and we've got to remind ourselves also that markets tend to go up over time, and that if you sell into the panic, it is much more difficult to make that back. I look back at the incursion, invasion, annexation, Hendrik, whatever you want to call it, of Crimea in 2014. This is not Vladimir Putin's first effort to take back parts of Ukraine. We saw markets sell off a bit when that occurred back in 2014, only to rally strong for the rest of the year, and indeed, basically since then. Could you foresee, assuming no inflation or global central bank-led slowdown in the economy, just Russia, could you foresee a similar situation where markets could be nearing a short-term bottom on an overreaction on this news?
Brian, it's very difficult calling the time, but I think in the course of this year, we are going to see a sort of bottom, and the world readjusting or adjusting to a Russia living with sanctions, to jostling for position along the NATO-Russian border. And that's just going to be part of what really is something Vladimir Putin has been calling out for many years, the establishment of a multipolar world or a new world order where it is not as clear and simple as it was after the Second World War. And I think investors, business people, we all need to live with this. My concern here is the impact on energy markets and what that will do to not only inflation, but what that will do to disrupt ordinary business around the world.
Yeah, and Hendrik, I guess the confusion that I've got is that there's two ways to look at this when it comes to U.S. Federal Reserve or ECB or Bank of England policy, which is, number one, concern about potential slowdowns could reduce their desire to raise rates as aggressively, or, to your point, I think, this increase in commodity prices could force their hand to become more aggressive, even at a time when parts of the world become on edge. How would you see it?
Yes, and I think this is a moment where we shouldn't be overly obsessed by near-term asset prices. If we were policymakers, what we should address the longer-term fundamentals, and allowing either bubbles to build up or too much cheap capital to wash around is not healthy for long-term capital allocation. So I would urge policymakers to remain focused on their task at hand and let the politicians do what they do. We are in a more messy world. But I think the thing that worries me, Brian, is last year we built up a decent consensus around net zero and around how to address the major issue we all face, the existential issue, which is climate change. If we don't keep channels open between East and West and between various governments on that issue, and if we don't keep financial markets and businesses focused on the energy transition, we will have a problem down the line, which will ultimately degrade the quality of our portfolios. So I would really, really urge, particularly policymakers, to maintain open dialogue on those fronts, even while there is geopolitical conflict and tension of the sort we saw the last few days.